7 years old, and made $3,000 that summer selling chicken eggs to the neighbors, and kind of we built a little mini business out of that, and kind of have grown that, always with a passion for entrepreneurship. I knew that was my kind of calling in life, and was very excited about that. We back in kind of to give a little bit of history, back in the mid 90s, 1994, I actually had a buddy of mine that I actually met in first grade. He called me up and he said, "Hey, Josh, I know something that nobody else knows, and we should talk about how we could leverage that." And I said, "Well, what's that?" He said, "That's the internet. The internet's going to be huge." And in 1994, and I thought, okay, well, what's the internet? And so we started a journey in starting we started art.com and allposters.com, selling posters and prints online and offering custom framing services. My buddy was we're both co-founders, of course. He was the technical side of things, and he built the business and the website, things of that nature. And I took care of the other parts of the business. We built a really good business. We were really blessed. Through the years, we built it, and we bootstrapped the business with $35,000. We tried to raise money from investors, and being 19 years old, 20 years old, it was very early, and nobody would invest in us. So we tried to get $250,000 and couldn't make that happen. A few years later, we tried to raise $1 million or so and didn't make that happen. And so for the first 10 years of the business, we just grew it, and brick by brick, slowly making it happen. In 2002, some of you may be familiar with Inc. magazine. They do a Inc. 5000. They list the 5,000 fastest growing companies in America. And in 2002, we were number 2 on that list overall. And so we had I'm just giving some reflection on the growth that we achieved and what we experienced. We did 2 years later, we did raise our first round of venture capital. We set out to raise it was our first and only round. So we kind of call it our seed round, yet it was $58 million. So it was a lot more than an average seed round, of course. And we built the business and continued to build it. Lifetime. I said towards the end of the business, we were filling a tractor trailer with posters and prints every 20 minutes, 24/7. Lifetime with the business, we satisfied 23 million paying customers and did just shy of 3 billion in sales, and sold the business 2 years ago to Walmart. As kind of I reflect, that's kind of my story. I mean, it's a little bit boring in a way, because it's the same thing for 15 years with the same company and 20 years, and building that out and making things happen to that. But it's also has been a great learning and a great history for me, and I've really enjoyed that. And as I even while I was at art.com, I started making angel investments and investments in privately held companies, and I've made 35 of those investments, and I've seen about a third of them go to zero. So I've ideas I thought were good ones turned out to not be good ones, or didn't make it. And others have done really well. I have one opportunity that's is already over 80 times the investment that I invest. So $100,000 turns into 8 million. And it's interesting because that far outweighs the entire investment in the whole portfolio. And that led me to kind of thinking about, I'm a math guy. I love mathematics and analytics, all the pieces that go with that. And so being the data geek that I am, I kind of, I dove into the data behind startup investing. And I found, I started gathering data. And so on that note, I'm going to share my screen. I have the deck for the business for Fundify, and because now I'm realizing that I'm already starting to go in. I started talking about myself, but now we're in my history. But let me show you some of the data and what I have in the deck here. Can everybody see this? Kirk, can you see this? I know others may be muted.
Yes, I can see it. Sorry, I had myself muted.
No, that's okay. I just want to confirm. Thank you.
Good.
So this is what we set out to do with Fundify, is to solve the radical inefficiencies of startup funding. Um, what's became really evident to me, and what's really interesting, is that everybody kind of knows that startups have a difficult time in raising capital. But through the years, as I made those 35 startup investments, I learned that it's actually really difficult to deploy your capital in a prudent manner. And that led me on this journey of kind of how could you solve that issue on both sides of the equation to make it faster for startups to raise capital, faster and more efficient and more effective for investors to deploy their capital. So that's what we set Fundify to do. Is kind of where we think it is. There are hundreds of billions of dollars waiting to be invested in startups yet for investors deploying their capital. And for startups, raising that money is inefficient. It's unsophisticated. It's radically time consuming. We go to lunches as investors. We meet with entrepreneurs only to find out that, the idea is, we really think the idea is never going to work, let's say. And yet we spent an hour and a half looking at that. And so we want to curtail that and build a process that lets you look at only the best ideas and the best opportunities that are out there. Meet Fundify. That's what we're building. And our mantra is to simplify startup funding. And when I say that, I want to simplify it for startups as well as simplify it for investors. This is just a couple of shots of our website here and what we're building. We're currently in the process of building all this and taking some next steps here. This is kind of where I was as I was telling the story of my journey. I started diving into the data around angel investments as an asset class, if you will. What do the returns look like? My returns were very strong. And so I thought, what do they look like if you were, could I buy a startup index fund, let's say, or an ETF that was specifically targeted for startups? Well, you find you really can't do that. Now you can buy a venture fund, large minimums, but a typical venture fund, you're getting exposure to 15 startups, and they're often later stage. So they're more the 3 to 4x sort of outcome that they're trying to have with really very little opportunity to see a 30x or a 300x inside of the portfolio. Now I found a total of 27 studies around the world. I have searched and I haven't found any others that have more than 200 investments in each one and that talk about the returns. And as you can see, kind of I pulled out a handful here, but they range anywhere from 15%. One of them is at 72% in the returns. And what you see here is a cohort of those. And you find, hold on. And so what you'll see is the returns are all over the place, but the lowest returns in any study was 15% annual positive return, and that's an annual IRR, whereas the highest was 72%. In aggregate, if you took a look at the raw data, it turned into about 28% across the board. That means if you were throwing darts at investments that people made already, and you could invest alongside them, you were getting returns of 28% a year, compounded annually, and the average investments. Now, of course, for those of you that may have experience in startup investing or even in real estate investment, right? Once you buy that land or once you invest in that startup, your money becomes illiquid for for some particular length of time. And in the startup, it's even more so, right? Because you are investing and now you have to wait for an exit of some sort, right? Whether that be stock repurchase of sorts or a sale of the company, an acquisition of the company. And but the returns, as you can see, can get quite high. Now this is another slide that was done by Robert Wiltbank, a professor with the Kauffman Foundation and also with the University of Washington. Just something that most of us know, where savings accounts are returning very small returns, whereas blue chip stocks in general, real estate, you see here on the list, 8.6% in aggregate. But angel investing, according to this study, came in at 27% annual returns. Very, very high asset class in the return side of things. Here's just a slide on myself and my COO. Craig comes from, I've already talked a little bit about mine. Craig comes from so many different areas, but he has a vast amount of experience. He was with Apple. He in the early days of Apple launching the first gaming consoles and gaming systems on their platform. He's been a part of an angel group called the Seed Stage Incubator that looked through 800 different opportunities in the startup space, and he's my right hand man in the business, and we're excited to have him. And we've got our team is a relatively small team. We had 5 people as of 2 weeks ago. We have 2 more now, so we have 7 people on the team, and we're executing. And happy to talk more about the team to the extent that's appropriate. Maybe when we get to the end and have some question time. The other thing that we did as we look at the asset class as an investment in the returns, we looked at trying to understand what kind of cohorts, how could we cut up the investment in that asset class to find higher returns. And what we found is that there were 2 things that made an impact on returns in a statistically relevant way. And they both had to do with the investor, which was very interesting because most of the things we looked at were things like, or criteria like how many employees were at the company when they started, were the founders male or female? Did that make an impact on the returns? How many founders were there? What industry were they in? Those types of things. And all of those areas had minimal changes in what the returns were if you were to invest across the board, what the age of the founders were, things of that nature. Minimal. There wasn't any statistical kind of sampling that showed you conclusive evidence that you could have higher returns doing it one way or another, outside of the 2 that we found that were around investors. And one said, did the investor do at least 15 hours of due diligence? And did the investor have any relevant experience? Did they know anything about the space that they were investing in? And when they did both of those, we found returns that could showcase upwards in the mid 40 percentile, sometimes in the 50 percentiles, as far as returns that were coming back from the investments that were made in that kind of situation. My apologies for the phone ringing over here. Can't exactly turn that off. They try to at least. Okay, so that's one of the things we found. And we also, another way we sliced it is the same sort of thing. We looked at the 18,000 startups that were in those 27 different studies. And we kind of looked at the prior investment returns. And we found that although the returns were still positive, you had no prior experience. When you 1 year or more, or even, of course, the more years, the better. But the bulk of it was really just even with 1 year of expertise and experience in that space, you saw a considerably higher result in the returns. And the same sort of thing from a diligence standpoint. As soon as you started spending more diligence time, you saw higher returns in that cohort and you were building. And so this data all comes out of another returns to angel investors in 2007 from Wilt Bank, showcasing some of these items. And so we have built Fundify in a way where we believe industry experts are the answers, are experts. So we're building an expert network, if you will, on the Fundify platform. They are all accredited investors and they have professional relevant experience in some particular field. Some have experience in one field, some have experience in 3 or 4 fields because they've spent years in those areas, and others, and if they don't, then they're not part of what that is. And the idea there is, as startups come to Fundify, we take a startup, it's in the telehealth medicine space, let's say. We work with the startup to get a profile built that is, they've answered all the questions that we all would want to hear. And after that being done, we then introduce them to some expert inside of our network that has expertise in the telehealth medicine area. And then that person now can vet them out and can review that opportunity and decide whether that's of interest to them. And if it is of interest, then we can look towards the possibility of possibly, investing alongside that at the same terms that they have. I won't go too much into this slide, but this is about the Fundify advantage and all the things that come when you work with experts. There's less time required of the founder. It's less time in due diligence because the founder already, the investor already knows about the industry that they may be investing in. Fundraising processes take weeks and not months. Then there's network effects of the advantage of what we're building because we're doing it on a platform. And now with some of the new regulatory laws coming into play, and we'll talk about that in a minute, but you're allowed to solicit investments from people you didn't previously know. You have 3 times more top performing companies and higher expected returns based on what we're seeing here in the data that we're kind of going through. And so really, we see this as kind of an ecosystem where you have to have startups and experts, but you really need to incorporate, startups and investors, but you really need to incorporate experts into what you're building. So that's what we've done inside of our platform in order to add credibility to any startup offering that's there. Otherwise, you're just reviewing the next great, I don't know, machine that can, Zumba that can mow your lawn, and you really don't have a landscaping expert or somebody that understands that type of equipment expert to give you their feedback on why that might fail, frankly, as you really want to know any pitfalls that you might run into. And so that's the model that we're building out. Before I go into some of the SEC regulations, maybe I'll take just a moment here, Kirk, if there were any questions up till now that from you or anybody else.
Well, you had told me earlier today when we spoke, you told me that you had been a little bit surprised and even discouraged about the expert process. Go into that a little bit because I thought that was interesting.
Sure, yeah. What was interesting is that our experts, we would showcase them to start. We'd look at a startup and we find a startup. Oh, this looks fantastic, right? This looks like a really great startup. We finally got, another great one to go on our platform, and then we'd share it with an expert that knows that space. And what's been interesting is, just as an example, this, we share one. The expert comes back after reviewing it and tells us, I'm not going to invest in that company. Okay, why not? Because we were hoping, of course, ultimately the holy grail, if you will, would be if an expert likes it and not just says they like it, but actually deploys capital. So they really like it. Well, this expert tells us, no, yeah, I wouldn't invest in this because of this, this, and this. And we're looking at that and saying, oh, wow. The way I put it to Kirk earlier was like, hey, I thought it was a new shiny ball out here that I could play with, right? And I could invest in it. I thought it sounded great. And yet when the expert spoke to me about the challenges that this company would face, I thought to myself, wow, those are some really great insights. And so that the downside to it all is that it made it difficult because we found a few startups that we thought would be really strong and our experts actually nixed them. But then really quickly after that, we actually started getting really excited because you think about that and you say, well, isn't that the whole process? Isn't that the whole reason we're building it the way we're building it? Because we want the experts to tell us which ones are the best, right? We want the guy who has experience in battery technology, and he looks at the opportunity and says, wait, I have seen a lot of battery companies in my 10 years or 15 years at Samsung's battery department, and I've seen a lot of companies doing things similar, but this company is special. And these are the reasons why it's special. And as a matter of fact, I'd like to write a check to them. I'd like to invest. How do I do that? And let's talk about that. That now becomes incredibly compelling because I don't have an electrical engineering background. If I were to invest in this cool startup that does batteries, you may think, oh, that's great, Josh, invest. But the reality is, what do I really know about batteries, right? And I don't know enough about them. I know enough about them to be dangerous. And so I end up in the middle of the pack and maybe lower than the middle of the pack of that entire range of investments in this asset class. And the people that are getting the higher returns are the experts, are the expert-led investments. So we are encouraged by that actually, ultimately, but that's right, Kirk, and thanks for asking that. Any other questions?
Okay, well, let me do this. I'm gonna push a button here that asks everybody to unmute. So if anybody has questions at this point, we can jump in there. If not, we can move on.
Hey, Kirk, it's Joel Lindsay. I do have a couple questions, if it's okay.
No, please go ahead, Joel.
So the first one is sort of how is the expert identified and incented in this kind of process? And then the second is how are the startups originally identified and sort of matched up with Fundify?
Great question, Joel. Thank you. The experts themselves. So the way we work is we're opening it up to have experts join our platform. They can kind of apply to join anytime they want. And as we've seen from the data that really even a year of experience already sees significant value in looking at something, because we learn a lot in a year of full-time work in a particular industry. And so when they start, an expert essentially joins our platform and we have not vetted them. We have not gone through kind of at least right now, not a rigorous review of things. And we even haven't, we start doing that. We do a cursory look of that when a startup matches with their industry of experience, the industry that they're experiencing matches the startup's industry. Then before we actually officially make the match, we take a look at the expert and we say, oh, okay, do we know anybody that knows this person? How do we get in touch with this person? Oh, they're a venture partner at this place, or they're, they founded this company, or they spent 10 years at this company. And then we start essentially almost like an interview or a background check or those types of things. And we especially want to do that towards the end, where if he's actually going to make an investment, and if we're going to talk about the fact that, hey, he is accredited and this person is also an expert, then, we want to kind of showcase who they are. We'd want to do a little bit more diligence. So we allow them to open up and kind of join, and then we do the diligence before we actually launch with that opportunity. That's the idea, at least, and that's where we are. And I hope that answered that part of the question. On the startup side, so far we haven't done any marketing. We haven't spent any marketing. The product itself is extremely viral, and I can walk through why that's the case. We have had over 1,300 startups already apply to raise capital through us, which is a ridiculous number. Some of the biggest firms I know in the country are kind of advertising the fact that they're seeing 300 to 400 startups in a year, and we're seeing 1,300 over a course of months. And the reason for that is because we're doing it via a platform, and we see startups input their information, and we go under the premise when they input their information, what do you do? How do you do it? And then we kind of get to a place where we tell the startups, we need to add credibility to your offering, because otherwise you're just a guy that's talking about your business. And now what do you do from there? How does that work? And so we ask questions like, who's invested so far? Oh, we have 3 investors. So they tell us who those 3 investors are, and they enter that on the platform and invite them. We also have, we might have now who's on your board? Oh, we have 3 members of our board. Here are two members. Let me share them with you. We also have 4 people that work with us, and these are the 4 people and what they do at our startup. Before you know it, you got a dozen people that they've identified, maybe even an accelerator or an incubator or an angel group that they've been a part of. And every one of those touch points becomes a point where we now say, okay, we're going to verify that you have a relationship with this person by reaching out to them. They provide the email address. We reach out to that person. We say, hello, sir. Hello, madam. You are associated with this company in this way. Can you verify that? And I mean, almost every time it's happening, certainly over 80% of the time, that person is saying, oh, you're doing this because they're raising money. Oh, so you help them raise. Fundify helps these startups raise money. Oh, that's great. And then they say, I know another startup that is raising capital. I wonder if this would be a good fit for them. And what do you think? Yeah, it's me. And we're industry agnostic. We look to help startups raise capital. So if they're a startup and they're looking to raise capital, we think we certainly could be a fit for them. So we'd love to talk to them. And they put them in the system in a filter, and it really multiplies on itself really fast. So that's how the startups come to us. I mean, the startups are in a way the easy one, because they have a need that they need to remedy, right? They need to raise capital in order to fulfill the vision and dream that they've come up with. And so they're kind of willing to do, for the most part, whatever it takes to raise capital, and they're willing to work and make those things happen. So does that answer your question, Joel?
It sure does. I appreciate it. And thanks for taking this call tonight. Appreciate it.
Oh, thank you. Appreciate it. Anybody, any other questions? And then okay, I'm going to just kind of fly.
You have, excuse me.
Yeah.
Can you hear me?
I can.
Yes, sir. Yeah. So the question is, so you will be investing the money just like mutual funds?
So interestingly enough, there are some correlations to that. The way the platform will work initially is that individuals will invest through an SPV. So we'll create a special purpose vehicle, a legal entity that you invest in, and that entity then invests into the startup. And in some cases, we won't use special purpose vehicles. We won't use legal entities, and you would invest directly into the startup. But we do have some plans to build essentially a mutual fund where we are like the manager of that fund, and we review the opportunities and we deploy the capital that others have given us. I mean, we are aiming to build the first startup ETF or the first startup index fund available to the world. And so we are already in discussions with a group out of New York and here actually in Austin that have over 500 billion in management, that are experts at taking products that are not currently available to the public markets and creating a public vehicle for you to invest in through a public, so that you could be on your E-Trade account or on your Robinhood account and actually buy Fundify, whether it's a mutual fund, a private equity firm, a SPAC these days. And through that money gets deployed into that area. And then that money that we have, Fundify essentially becomes the manager, the general partner of that fund, whether it's a mutual fund or a venture fund, if you will, or an angel fund. That capital then gets deployed into the startups, and investors now, they trust Fundify as a fund, as a manager of the fund, and they deploy a large amount of money into the fund that will deploy it into multiple different investment opportunities. Initially, though, we're starting where the individuals would invest only in one startup at a time, but we are already working with lawyers to kind of work through that opportunity. There are some legal items that we just have to figure through.
Yes, sir. Yeah.
Okay. So the startups can be, are you aiming at any particular kind of companies, or it would be a wide range of companies, right? It could be from tech to pharma to alternate energy to the regular commodities. Is it going to be something like that, or
Yes, sorry, I didn't mean to cut you off.
No, that's fine. Yeah.
I think you have it right on. Yes, we call ourselves industry agnostic now, and later on in the deck I talk about, we take a fee on the capital raised, and we also take a carried interest on the investor side on the investments that are in the event where that fee can be, for example, at our discretion, can be in cash from the startup, or it's a success-based fee. But it can be cash, or it can be equity in the business in lieu of cash. And an example I might give, let's say, for example, it's a restaurant, it's a local restaurant in, I don't know, a small town in America. Well, that probably would not be of interest to us to own equity in this business, right? But in that case, we might just take the cash that's raised from from what's raised, and we earn our fee. We take cash, and that helps us with operating fees. On the other hand, let's say that same restaurant was starting, but we learned that let's say the founder of the Cheesecake Factory has left, and now he's starting a new restaurant, and his actual plans are to build 4,000 restaurants across America, and this is just his first one. Well, in that case, I actually might go the complete other way and say, in that case, I might take an entire equity stake in that business as opposed to cash. And so that's how we're thinking about that. we would have, yes, we'd have a consumer products section, right? Somebody might be starting a new beverage company, okay? And we can make decisions on that. Of course, we'd have that organized on the website, on our platform, showcasing kind of the different areas that you could invest in healthcare, biotech, nanotechnology, energy, whatever it might be. We consider ourselves industry agnostic.
Okay.
Can I ask you the last question, sir?
Sure.
Yeah. So we have some investments through Kirk, and it kind of ends in about like 5 years or something. So this is indefinite, or we can move our money out?
Well, the way that, if I understand the question correctly, once you've invested, if you invest and choose to invest in this, Fundify, from a perspective of Fundify, it's a little different maybe than a real estate fund, and probably Kirk can talk to that a little bit later. But from our perspective, yeah, you invest into Fundify, into the company. That's the same. You would be buying the shares of Fundify, the same shares that I own, except with preferences. And now that's the value of the org we're building. Exit will come in a way. The exit might come, if you compare it to a real estate investment, it would come when it sells or when you have some sort of liquidity event happen, right? So sometimes, you predict, maybe with sometimes with real estate, you think I can do this in 3 years, but it takes 5, right? And so that means, well, you got to wait till 5. And the same sort of thing here. Now, let me take a minute while we're talking about that, if you don't mind. I'm going to share part of what got me into the business that we're in is, so at art.com, I mentioned we did raise 1 round of ventures, 58 million from 2 of the larger venture firms in Silicon Valley. And through that, of course, we built a relationship with these firms. And at one point, I was able to have a conversation with one of the partners of the firms, and over a couple hours. And I'd asked him, hey, how'd you build this? How'd you make this happen? And he said, well, it's kind of by accident. I said, okay, how'd that happen? Accidents are interesting. He says, well, I was meeting with the founder, a gentleman, Pierre Oidemar, who happens to be the founder of eBay. But he was meeting with him right when eBay was getting started. And when the gentleman, Bob, the gentleman I know, he heard this idea, he thought, wow, this could be an incredible idea. I love this. And Pierre is raising $6 million for eBay to get it started and off the ground. And Bob says, you know what? I'm going to raise you the entire $6 million, if you don't mind. And they say, okay, great. They go, and Bob raises the $6 million over the course of a couple months and invests it in eBay. Now, same sort of thing. It's kind of an unknown end, right? When does that happen? When do you get your money back now that you put X amount of dollars of the 6 million into, and you own essentially a piece of eBay, but years go by and you haven't gotten anything. Well, when eBay went public, that's when that kind of transaction happens. It goes public, or if it were to get acquired, that would be another way to get kind of a liquidity event. When eBay went public, what was interesting is that $6 million investment was now worth $8.5 billion. So that Bob and his firm, the deal they had was, the deal they had with the investors was, the first thing we're going to do is pay you back any investment that you make. So they got $8.5 billion. They paid the $6 million, which means they still have $8.5 billion because it's such a huge number. And then their cut was 20% of the $8.5 billion. So Bob and his team received $1.7 billion worth of eBay stock. And I thought to myself, wow, that's interesting. And a year later, wow, what an anomaly, I'm thinking. And a year later, I'm sitting down with a friend, Jeremy Liu, out of New York City, who tells me he's done the exact same thing with a 4-person startup that we now all know is Snapchat, but they were raising $475,000, and he ends up facilitating, grabbing that $475,000, investing it, earning a 20% carry. That turns into $1.1 billion. And Jeremy, who just put the money together, organized the capital and gave it to took it from the investors, invested it into the startup. He got 20% of the 1.1 billion, which is $220 million in Snapchat stock at the IPO. That's essentially the way, or if you have an acquisition and you sell your business for $500 million, and at that point, we would take that capital and disperse it to every group in the proper pro rata portion. What became really interesting to me is I learned that this is happening way more than you think. It's happening. Now, I don't want to misrepresent that it's happening in every deal, because of course it's not, but it's happening. And there are now almost 600 companies in the United States that are of unicorn status or worth $1 billion or more that started out as a startup, right? And they're growing very fast. They're more and more each day, and you're just hearing about them over and over. So I'm not sure I answered your question there. So I want to see if I have a follow-up or if Kirk needs to touch on something.
Josh, I think my question is, so, and I think that their questions reflected in this is, are there dividends involved, or is this stock buybacks? So let's assume there is no liquidity event in terms of an IPO or someone buying the company. How then does the investor make money on their investment?
So that's a great question. Thank you, Kirk. Thank you for clarifying. Let's say we have an event where our idea is to invest in thousands of companies eventually, right? And transact thousands, millions of investors, really, tens of thousands of startups, organize them and invest capital into them. And every single time we do, we are going to earn a piece of what those gain. Let's say we were able to, 7 years ago, put together the transaction for DoorDash. That was $2.4 million that they raised. They transacted this $2.4 million. That turned into $3.6 billion. And if you had transacted, if Fundify had put that deal on the platform, we would have taken 20% of the gain there of the 3.6 billion, which would have been $720 million. That capital would come into Fundify, to the Fundify Inc. organization, our company. And at that point, management, essentially our leadership team, our board, we would review that opportunity and we'd say, okay, now we have a company with $700 million in the bank. How do we want to best use that? And to the extent, so what I did at art.com, let's say, so with art.com, what we did is along the way, we made repurchases of stock. And this is very common in Silicon Valley and a great way to do things. If you pay dividends out to investors, for example, Fundify would have to pay taxes on that dividend. And then when you all as investors receive that capital, you'd also have to pay tax on it, except it would be taxed at it would be taxed at ordinary income rates because it's a dividend and that's how those are taxed. However, if we did this in the form of a share repurchase, which is what we did at art.com, we would say, okay, we've got, let's say it's DoorDash. Okay, we've got 700 million. We're going to take 300 million and repurchase. We're going to use 400 million to continue to build this company, which is an enormous amount of money. But we got 300 million and we want to disperse it to our shareholders. Okay, the way we would do that is we would ask our shareholders, these are the options. This is the price per stock, per share. You own this much. How many of those would you like to sell? The maximum amount, this certain dollar amount, this minimum amount, that sort of thing, or none at all. And then each investor can make their decisions based on that at the current time and decide whether they want to. Now, the benefit of that, and then we repurchase based on that algorithm and we buy everybody pro rata to their shares and to their interests and what their desires are. The beauty behind that, one, from a tax perspective, the company doesn't have to pay a tax on that because so that's an investment really that we're making. And secondly, when you receive that, if you were to choose that you would sell some of your shares to get some of that cash, well, then you're actually would be taxed as long as it was 12 months or more, right? That you've held onto the stock, which likely would be the case, then you would be taxed at a capital gains rate on that. And then you also would own the rest of the shares that you own. And we would take those and that would continue to happen. So that's the idea. And I'll also add an interesting fact that there is the United States is a little behind from a legal perspective, from a law perspective, to where Europe is, and in particular where Great Britain is. Great Britain has a wonderful equity crowdfunding platform called Crowdcube. Now, Great Britain, much smaller than us, right? It's not as compelling from an investment perspective, but they now have 16 unicorn companies that have come out of Great Britain. And we just talked about almost 600 in the US, but 16 in Great Britain. 3 of those companies that are now billion-dollar companies raised their first money on Crowdcube. So that's 19% of the opportunities that are now billion-dollar companies started on a platform. That's going to be the same case in the US. Okay, we're going to see the exact same sort of thing. So the idea that none of the DoorDashes are going to end up raising money on a platform like Fundify, that's not true. They're going to raise money on the platforms. The question is, how big can we get? What market share can we own? How do we execute on the vision that we have in order to be successful, to have more of those billion-dollar exits, right? To see the $1 million we raise turn into $100 million, and then we get our piece of that. So, Kirk, I think I answered the question, but I want to make sure I did, and see if you had any others also, or if I can clarify.
No, I think you answered the question. I'll tell you what, let's do in the interest of time, because I think we do need to wrap up by 8 o'clock. I want to honor people's time. Let's go ahead and walk through some more of the deck to see if that generates more questions. And if you have current questions right now, just hang on to them for a few more minutes, because they may be answered, or you may come up with new ones. So let's go ahead and walk through the rest of the deck.
Great, thank you, Kirk. So one thing I want to talk about is the SEC regulations. Things have changed over the years. In 2012, the Jobs Act came out that allowed everyday Americans to invest in private companies, even though they're non-accredited retail investors. It took over 4 years, for that to actually go into effect. And now people can actually start making those investments. And there were just some recent laws that changed in October that are allowing minimums to go up. The $1 million, right now, a startup can only raise $1 million, $1,070,000. But that's going up to 5 million. Looks like in March, we actually got some legal things that are kind of happening in that front. And I'm trying to go fast here. But plus they're removing some accredited investor limits that are also going to increase. I'll have this in the regulation crowdfunding, equity crowdfunding space grew in October, which is the last data we have, grew 127% year over year. That is accelerating now with the impact of new regulation, that's new laws that are actually opening up to allow more investors to come in at higher rates, higher amounts. So we're going to see an acceleration going forward. Another thing I want to comment on is, for years and years, funds that have been out there were, the biggest funds in the world were $2 billion funds, $3 billion funds. And now all of a sudden, 5 years ago or 4 years ago, in SoftBank launches, the biggest fund in the world is a $15 billion fund, and SoftBank launches their vision fund with $100 billion. Only 2.5 years later, they raise another $108 billion. All of this allocated to invest in startups, because they're seeing the same data we're all talking about, that we're talking about today, and they're seeing what the returns look like in this space. And the returns that we looked at, the 28% annual returns, those are returns when you throw something at the dartboard, right? So it's very random, and those are the returns you're getting. So if you can do it better, you can see even higher return. Smart money is moving this way. This is a chart that shows you the 15-year trend, where the money that's made and the value that's being created in the past. Over on the left side, you see the gray areas on the bar. That is how many multiples you're making on your investment after a company goes public. And the red part is how many multiples you make on your investment when the company is private. Okay, in the last 15 years, that has completely changed. And companies all the value. You got the Ubers of the world going public at $80 billion. So how much could you, what kind of multiples could you theoretically expect if you were, investing in Uber at the IPO? Well, 15x would take you to the biggest company in the world. So it's unlikely to have 100x return yet. So what's happening is the Andreessen Horowitzes of the world, these big funds are getting bigger, and they're investing earlier down the funnel on startup investing. And what's happening is they're pushing money in, and what we aim to do is get invested in the companies even before they get in, because it really kind of works itself. It's a very positive outcome any which way that we look at it. So we see this massive trend of money going into private investments, as well as the regulatory changes, to producing a very large opportunity for us. I won't spend a lot of time on here. This is just a competitive matrix. There are some platforms out there now, mostly here in the top left, Start Engine, WeFund, or Republic. These are companies with low investment rigor, as opposed to what we're doing with our experts review. All these platforms do not have experts reviewing. Some of them are starting to think about having what you might call a lead investor of that sort, but they don't. They don't mandate reviews and things of that nature. And this is really, the left side is really where angel investing generally is. It's very early, and the rigor is low. Whereas where venture firms here, the early stage venture firms on the right side, are spending actually a lot of time making their investment decisions and evaluating those opportunities. So quickly touch on the business model. From the startups, we're taking 7.5% essentially of the capital raised. And that is a success fee only. So meaning a startup doesn't have to pay us anything when they join. If we accept them, they only pay that 7.5% upon exit. So if we raise $1 million for them at the closing, $75,000 would be our fee. We get to determine whether we take that in cash or in equity in the business. This same would be said if we now, with the new laws in place, we could raise up to $5 million for a startup. If we raised $5 million, we would get a $375,000 fee, and we get to determine, if we want that in cash or in equity in the business. The bigger piece is the investor section, which is in the middle here, where we would take upwards of a 20% carried interest, which we've already talked about, on investments that are made into the companies on our platform. And down the road, you could see some big things happening. We're already working on a broker-dealer status to get approved. We are a registered funding portal. I want to note that in December, we went through an arduous process with FINRA and the SEC and FBI checks and all the things you can imagine, because we're trading equities. On December 7th, we received our FINRA approvals, and 2 days later, we received our SEC, Securities and Exchange Commission, approvals to run a platform and actually transact equity for cash transactions online. Something that, for example, companies like Kickstarter, Indiegogo, GoFundMe cannot do. They cannot give an investor equity. They can give you a product. So you can give them $200 and get a bicycle in 6 months, a really cool bicycle, but you can't get equity in that business. And really, you're taking equity risk. And then we talked a little bit about managed funds, where we see down the road, we're already talking about potentially raising a $25 million fund, where we then invest that capital into the startups, and we would earn a carried interest on that as well. I'm not going to get too much into the example, but we've already talked about some examples on what we would learn, what we would make if we, if we're investing and raising capital for a startup. And let's say in this example there, it's becoming there's an acquisition exit of 243 million, which is the average. And this is getting pulled from some studies here for an exit from an acquisition perspective, and the capital that we would make over time. I have to update this slide a little bit. We've raised now 2.5 million from 26, I think, in angels, and we've had a couple that invested a little more. We are looking for. We did just get a commitment. We have 2 million that's been committed from an angel group in Dallas that is looking to close in the coming month here, and so we're working through that. But we're also looking through. And as I met Kirk and Mike, I love the idea of also having perhaps a little bit of extra capital where we can build on some of the things that we have that we don't have in the plan. And we'd love to build some more of those things. I'm certainly used to building with more capital in hand than a few million. We, at art.com, I had 1,200 employees by the time we were done. I mean, it started with just my buddy and I, but we had 1,200 employees, 5 different locations in Europe and in the US. And 175 of them were engineers. Today we have 2 engineers on the 7 staff, including myself. There's 7 people on the team. So we'd love to beef that up. And so to the extent that when Kirk and Mike approached me saying, hey, listen, we think we'd love to get into this. And Kirk has already invested. And as you mentioned, and we'd love to raise some more. We're open to raising looks like a couple million more, kind of evaluating that. And that's where we are. I have some appendix there, but we don't have to get into it. But Kirk, I'll hand it over to you. I know I'm trying to run fast because I know we're on the timeline.
I appreciate it. Well, no, I think the best thing to do at this point is to continue to open up to questions. So I'll let you guys have the floor, and then let's see. We've probably got about 5 or 10. I'd give us 5 or 10 more minutes, and I'll wrap us up here in a few minutes. So I'm going to open up to you guys. What kind of questions do you have for Josh? Josh, I'll ask you a question, or maybe it's not so much a question as I want you to be able to talk about something that you had mentioned earlier. What is the one-click invest that you had mentioned to us earlier?
Early in mid 2020, we ended up getting the trademark for one-click invest, and what's excuse me, what's important about that and why that's a big coup is, for those of you that were watching Amazon in 1995 and 96 as they launch, they ended up quickly acquiring a trademark for one-click buy. And the idea there was, we want to own the buy space. We want to own, when people buy something, we want to be the player, not just buying books, but we want to own the buying of everything online and want to make that happen. And we were able, under contention too, we had to fight other companies for it, and other companies were coming out, big companies were fighting for this trademark and the fact that we were going after it. And we did end up winning and receive the trademark for one-click invest, which now allows us to use one-click invest anywhere we are on the site as we launch here. We're very excited about that fact, and we're setting ourselves up in the consumer's minds and players' mind that differentiating ourselves from everybody out there, that we are here and we're the player. And one-click invest makes it very easy. You'll be able to deploy your capital very easy and great startups. Plus, we have a differentiator from an expert model, among other things that we're already planning and working on, because over time, you end up developing other things. I have just earlier this week, I guess maybe it was Friday. I had another company that's trying to do something like this, and they're now talking to us about, essentially folding and selling us all what they have. And so, kind of looking at how can we grow by acquisition, things of that nature. Again, more possibilities in this space, and something that we're familiar with. I did buy 8 companies over the time that I was the CEO at art.com, and 7 of the 8 were very positive outcomes. The only other one just didn't work out. It was actually probably a really big not a big one, but a mistake on my part to buy it. But the other 8 were really, really great. The other 7 of the 8 were great scenarios. We bought companies like Zenfolio for $20 million. We pulled $27 million in cash out of the company over 4 years, and then sold the business for $72 million. And those are the types of things that we're going to do we're going to try, I should say, to do the same sort of thing in Fundify. See opportunities, grab them, leverage them, execute, and deliver results, right? And that's deliver results to our shareholders, and which I'm the biggest one. So I want to see that happen. Yeah. So, yeah.
Excellent. All right, I want to give you guys one more shot for a question before we wrap up for tonight. Anybody?
Kirk, can you hear me?
Yes, sir.
Yeah, Kirk and Josh, again, this is a very basic question. So once we invest, so will we be getting dividends every month like we do as we speak through Kirk?
So, well, Josh, go ahead. You had already referred to dividends earlier, so go ahead and let you.
So the current plan for Fundify is that we would not be paying dividends. It's different than a real estate fund that may do that, or paying off based on rent checks or something of that nature. The way that generally this is done, which has worked well in Silicon Valley, and kind of the way we're thinking about it is that no, we are not planning to pay dividends. I'm not opposed to dividends. I'm not saying no to them, but the current plan is no on dividends. The exits, your exit would come with my exit. So as we build the business, as we have successes in startups, we would take that cash and actually deploy it. Now, there's also the opportunity that if we have some success in the traction that we're seeing already, I mean, most people are pretty shocked that we have 1,300 startups on the platform. We already have 1,900 investors who have joined Fundify and want to deploy their capital into the startups. Once we're out of the gate, it's possible that we're getting a significantly higher valuation, and it's possible that we would take some of that. If we raised additional cash, we may use some of that cash to buy back shares again and offer the opportunity to for you all, if you're an investor, to sell some of what you own to get back a portion of the investment. One of my to give you an example, one of the investments I made, I made I may have touched on this. I made an investment in a company called Mixbook. Idea on a napkin, $100,000, 12 years ago. 4 years into the business, so that I'm out the 400 of the 100,000. I hadn't seen anything for 4 years, but 4 years in, we were able to construct a situation where they raised some money, $11 million they raised, and they used $3.5 million of that to repurchase shares. And I was able to sell 20% of my shares for $500,000. So I got 5X on my entire investment, but I got to keep 80% of what I own. And now since then, that 80% that I kept has now tripled. And so I'm running at about 85 times my investment that I made in that business. And I've got my entire 100,000 back 5X. And that's the situation that we'd like to kind of create in an ideal scenario. If everything goes well, that's what we're trying to create here.
Yes, sir. Yeah, Josh, thank you so much. Just one more question very quickly. So if for some personal reasons we want to exit, would there be any penalty on that, or?
Well, that's a good question. I'm not 100% sure. I do believe that the SEC prohibits you from selling your shares within 12 months of purchasing them, unless it's a liquidity event from the company sort of thing. But after 12 months, I believe you're allowed to sell them. Kirk, I don't know. You'd have to think about how that works with the fund. But, right. But I think outside of I think that's the only limitation from the SEC when you buy under the Securities Act and you're buying the stock. So,
yeah, and that's something we can talk about offline.
Yes, sir. Thank you.
Thank you.
Excellent. Well, I hope it's easy for you guys to see why Mike and I are excited about this opportunity. I think that by bringing experts into the mix, you increase the likelihood of these investments doing well, and to own a piece of the platform, the company that is handling eventually thousands of different startup companies. You can see the power of the scale of that, to own a piece of a business that could be very, very lucrative. Every investment has a risk. We know that. This is different than a real estate investment. We know that. But nonetheless, we were very excited. I mentioned at the very beginning that we Mike and I don't proceed on an investment opportunity if we are not comfortable and confident. And that is our desire, is that through meeting Josh, that you would grow in your comfort level and grow in your confidence that if this meets your investment desires, that it may be an opportunity that you want to take advantage of. So Mike and I will have conversations with you guys individually here over the next week or so. In the meantime, if you have more questions, you can send them to me and I'll get answers from Josh. And Josh, I want to thank you so much for your time tonight, and I appreciate you walking through this in so much detail.
Yeah, thank you, Kirk, for the opportunity. Thank you all for joining. If there's anything that I can provide down the road next week, who knows when, whenever you like, I'm very open to that and happy to kind of discuss things. I found that there's a great value in having multiple people involved in an opportunity from an investment perspective, because I'm getting insight from everyone. One of our investors this morning sent me a 9-minute video of him running into a problem on our website, right? And I'm thinking, well, that was really helpful because I can pass that along to, to our engineers, and they're working on a fix and they'll have one by morning. And so that happens because somebody was vested. They want to see success. They saw one of our warts, if you will, something's not working. And so the more we have people that like-minded, thinking about, what we're doing and ideas that they have, we love hearing that. And it's, that method has worked well for me and companies in the past, and I hope to do the same thing here. So thank you all for your time. Thank you, Kirk. Thank you, Mike. Thank you for your questions, everybody. And I'm available, so let me know.
Great. Thanks, Josh, so much. Everybody, have a good evening. We'll see you soon.
Thank you all. Take care, Joel.